Good afternoon, everyone. This is Jen Felton with GoldenCare. Thank you so much for joining us today. We're very pleased to have Tom Fridrich back to talk about long-term care insurance tax advantages. Tom is with Mutual of Omaha, and he is an advanced market specialist. Once again, thank you, and thank you, Tom, for joining us today.
Thanks, Jen, and thanks to everyone who's on the line, taking time out of their day to review some of the benefits of offering long-term care insurance to clients. Like Jen said, I'm an advanced market specialist at Mutual of Omaha, and I work with advisors around the country on helping to devise strategies and plans and sales ideas for clients. So part of what I do is that, and then part of what I do is training as well, and so I'm glad to take some time out of my day to run through the benefits of long-term care insurance. As you guys have questions on the topic, please feel free to write them down, jot them down. You can, I believe you can either send them in via chat or via email, or we'll take some time possibly at the end to see if anyone has any questions. So let's get started on the topic. We've got about 35 minutes of content here, and then, like I said, we can see if there are any questions at the end. Please keep in mind that as we go through the presentation, I will be covering a lot of tax information, but it's not to be construed as tax or legal advice. Any clients that need that should obviously consult their tax advisor, but we are glad to walk through any specific circumstances that you have regarding sales opportunities or specific clients and talk about the general tax implications of what they're trying to do. Always happy to take those calls here at Mutual of Omaha and help you as you prepare to propose to specific clients or to groups or advisors out in the field. So I want to start off with a very short history lesson. I don't want to get in too deep here with history, but I think it is good to start with the very beginning of how these tax benefits were created as it relates to long-term care insurance. And it all started with HIPAA many years ago, created what are called qualified long-term care insurance policies, so that as you work with advisors, as you work with clients, they understand that the benefits that we are talking about aren't simply things that we're touting without any sort of backup or any sort of substantive tax code provisions, federal laws that support what we are stating are the benefits of long-term care insurance. You have 7702B of the Internal Revenue Code that was created as part of HIPAA that creates qualified long-term care insurance that provides the benefits that we're talking about in today's presentation. So while in most situations you may not use specific tax code references when you're talking about these benefits, you can feel confident that the benefits are supported by the tax code. And when we talk about qualified long-term care insurance, the specific requirements relate to benefit triggers that are provided for under HIPAA. You have to have guaranteed renewability features within the policy in order for the policy to be considered qualified, and then some provisions related to not duplicating Medicare. So most of the policies that are out there today in the long-term care industry are qualified. Certainly our policy here at Mutual of Omaha was created to comply with the requirements of qualified long-term care insurance. And so to the extent that's what's being offered out in the market, clients can feel comfortable that the tax benefits we're talking about today are going to be applicable to the policies that they are buying. Now, one of the ways that I try and help make the benefits of qualified long-term care insurance more easily understood is by making sure that people understand that long-term care insurance, generally speaking, is treated very similarly to tax-free accident and health insurance. So most people are pretty familiar with their health insurance and how that is treated from a tax perspective, in that if you work for an employer that's providing health insurance as an employee benefit, what's nice about the health insurance is you get to pay for it pre-tax, and any of the benefits that you get from the health insurance are not taxable to you, right? They're a reimbursement for costs that you've incurred. And so when you look at long-term care insurance through that lens and think of it that it's being treated similar to health insurance, then the tax benefits of long-term care insurance become fairly clear. Now we're going to jump through a lot of the various different scenarios in terms of how long-term care insurance is treated for individuals and in the business setting, but if you can keep that concept kind of clear in your mind, it'll help you a little bit more as you talk about long-term care insurance and the tax benefits. There are going to be tax benefits available to employers. We'll talk about that, and we'll talk about other tax situations as well to make sure that you understand some of the other benefits that are not as well known that are out there as it relates to long-term care insurance. I want to talk first about deducting premiums, and that's where we'll spend the majority of our time, because that is where a lot of the questions arise surrounding the tax benefits of long-term care insurance. And how you get to deduct long-term care insurance depends on whether you're an individual, a business owner other than a C Corp. And of course, we'll talk about all businesses, business types as we go through that discussion, and then we'll talk about employees as well. And what we'll see really is we'll talk about tax benefits as it relates to the deduction of long-term care insurance premiums that are good, better, and then best. And I'll explain which ones are each as we go through the presentation. So let's start off first with individuals. Individuals can deduct long-term care insurance premiums. So if you're looking at buying a policy and you're not doing it in the business setting, that's what we're talking about here. So think about clients or potential prospects that you're out there meeting in their home, and you're just talking about buying long-term care insurance to protect their family, and you're owning that policy and paying for owning it individually and paying it out of your own family budget. So when you think about that setting, what we get to deduct are eligible premiums, okay? That's the first limitation, and it's the last bullet there on the slide. So we're only deducting eligible premiums, and we'll see what those are here on the next slide. But we can only deduct the eligible premium if there are two requirements. One, we are actually itemizing our deductions on our tax return. So on the 1040, we're not choosing the standard deduction. We're actually going to itemize deductions. And then secondly, we have to have unreimbursed medical expenses that exceed 10% of our adjusted gross income. So the two items are I'm itemizing, and then secondly, unreimbursed medical expenses that exceed 10% of my AGI. If I can do that, I can deduct my eligible long-term care expenses, my eligible premium, my eligible long-term care insurance premium. So when I look at all of my unreimbursed medical expenses, my eligible premium goes into that bucket of unreimbursed medical expenses. So that eligible premium, along with all of those other unreimbursed medical expenses, have to exceed 10% of my AGI in order for my long-term care insurance premium to be deductible. So when you think about that, this is the good treatment, meaning it's not the best treatment you'll see out there for long-term care insurance premiums, but it's good. You have to jump through some hurdles, but at least there's a potential for your clients to deduct their premiums. Now, keep in mind, it's tax season time right now, right? It's March of 2019. We're doing our 2018 taxes. For those of you out there who do your own taxes, whether it be through TurboTax or tax cut or some other free service or paid service online, if you're doing your own taxes, think about it for yourself. How many of you are doing standard deduction and how many of you are doing itemized? In today's tax world, after the tax law changes, most of us are doing standard deduction because one of the changes that came about was the increase in the standard deduction. If you're married filing jointly, the standard deduction is $24,400. So it's hard to get itemized deduction exceeding that with some of the other changes that took place in the tax code. They capped the state and local income tax deduction at $10,000. So that used to be a large itemized deduction for many taxpayers. But with that capped at $10,000, it's hard to get up as a married couple above $24,400. If you're single, the itemized, the standard deduction is only $12,000. But a lot of single persons file as head of household. They have kids that they claim as dependents. And if you're head of household, you're at, I believe it's $18,500 for, actually for 2018 it's $24,000 for married filing jointly, and then for head of household it's $18,000. So again, hard to get above that standard deduction if you're head of household with some of the other changes in the tax law. So when we think about it, if you have to be itemizing, you have to have a lot of other itemized deductions outside of state and local income taxes that can get you above that standard deduction limit. But to the extent you have clients or potential clients that are itemizing, this can be another potential deduction for them. Now, I mentioned that you only get to deduct the eligible premiums. These are also sometimes referred to as the age-based premiums because depending on how old you are dictates how much of your premium you get to deduct. And so you can see the numbers on here for 2019. So I was just talking about filing our 2018 taxes. These are for premiums paid in 2019. The 2018 numbers are similar. They are adjusted annually for inflation. I do know that the age 40 number was exactly the same in 2018. 40 or under, it was 420. 41 to 50, I believe, was either 770 or 780. But the point is that annually these numbers will increase, generally speaking, for inflation. And so the older your client gets, the more they can deduct, and as long as they're staying within that range, that number will increase as well. So between 61 and 70, for example, that's going to go up each year for inflation, generally speaking. And so for 10 years, as their premium stays hopefully consistent, that number will adjust, and if they're not fully covered initially, perhaps that eligible premium will catch up with what they're paying for long-term care insurance premiums. So that's the story for individuals paying out of pocket. Keep that in mind. Remember what they have to do. They've got to itemize, and then they've got to have unreimbursed medical expenses, including their eligible premium, that exceed 10% of their AGI, and then you can deduct your long-term care insurance premiums. So that's good. Let's talk now about the business setting. So we're talking about, again, clients or potential clients that are looking at paying for their long-term care insurance premiums through their business. And whenever you are talking to a business owner, you have to distinguish between how that business is organized. Is the business owner considered self-employed, or are they a C corporation? So let's take first a look at self-employed. You've got a client or a prospect that's self-employed. What does that mean? These are clients that are either a sole proprietorship, a general partnership, an LLC member, or the second bullet says an S corporation. And these are greater than 2% shareholders, okay? They're treated as self-employed. So let's just briefly talk about different types of businesses that you see out there, because it is helpful to understand, how do I know what they are? I would have never maybe thought about asking the business owner in front of me how they're organized. So sole proprietorship, let's be clear on what that is. What is that? That oftentimes is somebody that got started in business. Let's say they started mowing lawns as a kid, teenager, and they started getting more and more lawns, and then suddenly 10 years later, this is their business, and they never fully incorporated. They were still just Tom's Yard Service, and all the neighbors used them, and like I said, he eventually branched out, and now he's got a little business for himself. He has not filed any sort of corporate documents with the Secretary of State, and he simply files what's called a Schedule C on his 1040, and that's where he reports all of his business income and expenses and then has a net. That's a sole proprietor. Still see lots of sole proprietors out there because it's easy to do. Don't need an attorney to file any documents, and there's no special tax forms except for the Schedule C. A partnership involves 2 or more people, and they have entered into, generally, most of the times, a partnership agreement. It's a formal document that outlines how their partnership is going to be managed and operate. So they have a formal partnership document, and they file a 1065 for their taxes. Typically, you might see maybe like a law firm, Fridrich and Fridrich Law, might be some sort of partnership. There are different types of partnerships, but either way, for long-term care insurance purposes and the tax benefits, they're filing a 1065. Doesn't matter specifically what type of partnership they are. They're a partnership, and we'll talk about the tax benefits for them. A limited liability company, you see those all the time now, or you might. They've become very popular. They are a specific type of business entity, and you file articles of organization with the Secretary of State. And that's how you become a limited liability company. Now, for tax purposes, many of you may not know this, an LLC can be taxed in several different ways. They can be taxed as a partnership, so they would file a 1065. They can file as an S corporation, which we'll talk about here in a second, or they can actually be taxed as a C corporation. So if you have a client there in front of you that tells you they're an LLC, you have to ask them, how are you taxed? Hopefully they know. Generally they will. If they're taxed as a partnership or as an S corporation, they're treated as self-employed, okay? So the S corporation is the other type of entity that's treated as a self-employed, and so this is a company that might be named XYZ Incorporated. And when you incorporate, you file documents with the Secretary of State for your state, but then you can choose as a corporation to either be taxed as a C Corp or an S Corp. If you file as an S Corp, you file an 1120-S with the IRS to file your taxes, an 1120-S. If you don't choose to be filed as an S Corp, or to file as an S Corp, the default is a C Corp. So that's a little bit of background on what a self-employed business is. It's a sole proprietorship, it's a partnership, it's an LLC, or it's an S Corp. So what are the deductibility rules for a self-employed business? Well, like I mentioned earlier, this is where it's helpful to think about health insurance premiums. The long-term care insurance premiums are treated as self-employed health insurance premiums. The premium's deductible up to the eligible premium, but you don't have to meet the 10% of AGI limit. So a significant hurdle is removed. 2 hurdles are removed because you also don't need to itemize to get this deduction. Because who are we typically selling long-term care insurance to in an S corporation or in a self-employed situation? We're selling it to the owner. You see that third bullet there for the employee. You get to deduct as the business owner the actual premium for any S or self-employed, for any employees of the business in a self-employment setting. So if your client is the owner of an S corp, partnership, LLC that's taxed as an S corp, any employees that they buy long-term care insurance for, that full premium is deductible, not the eligible premium. But what we typically see in the business setting is the business owner buying long-term care insurance for themselves and their spouse. They're not typically buying it for employees. So how that works for the business owner is the business deducts the eligible premium. The business owner actually has to report the full premium as a distribution of income on their tax return. So it's going to be included on the tax. It's technically included on the K-1, showing that the business owner received a taxable distribution from the S corp. It's going to be in the amount of the full premium. So let's say the long-term care insurance premium was $5,000. The business owner actually gets to deduct only the eligible premium on their tax returns. But again, they don't have to itemize and they don't have to exceed 10% of AGI. So if your client was, let's say, 71 and over and a business owner and that premium was $5,000, they're going to be covered by their eligible premium, right? Because they get $5,270. Now they only get to deduct the actual premium because it was only $5,000, but at least they're getting covered there. So in self-employed settings, it gets a little tricky how all of that works from a tax perspective. Because the S corporation, for example, is only deducting the eligible premium. And then it has to be recorded as income to the business owner and then deductible eligible premium. So that can get a little tricky. And here's something to remember about pass-through entities or self-employed entities. So for sole proprietorships, general partners, or I should say partnerships, LLCs and S corporations, the entity does not pay taxes. What happens is the business entity files a tax return with the IRS, but it's for information purposes only. They tell the IRS, here's our revenues, here's all of our expenses that we're allowed to deduct, and here's our net income as a business. That net income is passed along to the owners of the business, and then the business owners report it on their 1040 and pay the taxes accordingly. So not a lot of people probably understand that about LLCs, S corporations, partnerships. They don't pay taxes at the business level. So that's why you have a distribution of income when that premium is paid, and then the deduction comes on the individual tax return. Now let's talk about C corporations. This is really the best setting for long-term care insurance to sell it, is in the C corporation. So remember, you're talking to a business owner that's incorporated. So if you own a business and it's incorporated, those businesses will have Inc. in their name, INC, or corporation in their name. So that's a clue that you may have a C corporation in front of you. So if you're talking to Mary Smith, owner of XYZ Corp, ding, 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 now you know either an S Corp or a C Corp, you need to ask the question. Because remember, corporations can be either pay taxes as a C corporation or as an S corporation. So you just ask Mary, hey, I see you're a corporation. Do you file as a C Corp or an S Corp? And if she says C corporation, this is the best setting to be in. Because as the slide tells you, the actual premium is deductible for employees, shareholders or owners who are employees, and that owner's employees, the owner and the employee's spouse and dependents. So this is really a great opportunity for you to talk about the tax benefits of long-term care, because every business owner out there is always looking for deductions. And so now you get to talk about deducting the full premium, not just eligible premium, for the owner, the owner's spouse, and the owner's dependents. So that's a great thing. Now, with a C corporation, and remember, this can be an LLC as well that has chosen to be taxed as a C corp. So remember that too. Remember, when you have LLCs in front of you, you want to ask them how they're taxed. If they're a C corporation, big win again. The C corp actually pays taxes. And this is where you hear the idea of double taxation sometimes in the business setting. It's with C corporations, because the net income that a C corporation reports to the IRS on Form 1120 is taxable at the business level, and then any salary taken by the owner of the C corp is also taxable as well. But remember, if you think about it, salary to a business owner really is kind of a net thing anyways. A lot of times business owners take a salary. It is a deductible expense, but if they're not making a lot of money, what are they paying themselves? Not a whole lot. So, but on the other hand, some business owners pay themselves quite well, and it drives down that net income of the C corp, so you really limit the tax liability at the C corp level. So there are ways to play with that, but that's why a lot of times people talk about double taxation at the business level. It's with C corporations. If I'm an employee of a C corporation, this is really ideal treatment as well, because if a business wants to provide an additional employee benefit, long-term care insurance is really nice, because again, the business owner gets to deduct the premium. The employee doesn't have to take that premium in as income. It's paid pre-tax, just like my health insurance. And again, when I access the benefits, it's tax-free. So very, very nice treatment for employees who have their long-term care insurance paid by their employer. Deductible to the employer and tax-free benefits to the employee. Now, I've got a couple bullets on there about not subject to the AGI rule and not subject to age-based limits. I don't want you to get that confused. If my employer is paying my long-term care insurance, I don't get to deduct it on my individual tax return as well. That's simply for the business. You know, the business is paying for it. It's deducted at the business level. So I have to admit, those last two bullets can be a little confusing. Now, I've been talking about how the benefits of long-term care insurance are tax-free. To the extent that the benefits reimburse qualified long-term care expenses, they are tax-free. Okay? But some long-term care insurance policies are indemnity policies where they pay out in a lump sum. They don't ask for receipts to reimburse the insured for costs. And so under those policies, clients have to keep in mind that as they access benefits, the benefits will be tax-free to the extent that those benefits that are being provided don't exceed the greater of the long-term care expenses or the per diem amount, which is $370 per day. So with those indemnity policies, clients just have to be a little bit more careful that they're not exceeding the greater of that limit. So the annual limit that you can get from a long-term care insurance policy under the per diem of $370 per day is $135,000 and 50, $135.50. But if your actual long-term care expenses are greater than that, you can get more than the per diem. So, and that just makes sense, right? If I'm actually paying out costs greater than the per diem, I shouldn't be taxed on it. But that's where clients, if it's an indemnity policy, would want to keep their records of how much they've paid out in case the IRS comes knocking and asking, hey, prove that these benefits should be considered tax-free. Sometimes there are policies out there that provide return of premium upon, and typically this provision is triggered with the death of the insured, and if there's hasn't been an access of any policy benefits, the premium will be returned. The return of premium is tax-free to the extent there was no deduction taken on the premiums. So if your client has never taken a deduction or had an employer pay for their premiums and a return of premiums is being paid out on their policy, then that return of premium is fully tax-free. But to the extent a client did take a deduction, then any amount deducted would be taxable income. Any amount received over what was taken as a deduction would be tax-free. So it gets more complicated if there is a partial deduction taken on the long-term care insurance premium. So think about the situation where somebody's only deducting the eligible premium and their premium was actually greater than that. You're going to have some returned tax-free, some returned taxable. In the employer setting, what's also nice when you're selling long-term care insurance is the employer can discriminate. If they want to buy insurance for the owner only and the owner's spouse, they can do that. This is not, even though it's considered health insurance for deduction purposes, it's not like health insurance from an employee benefit perspective that you have to offer it to everyone. So that's a really nice benefit of long-term care insurance. You can carve out who you want to cover. If it's the owner and some key employees, that's fine. You can do that. And so it's a nice benefit to promote along with the deduction in the business setting, because a lot of times what employers think is, oh, if I do this, I've got to provide it to everyone, and that's simply not true. So make sure you remember that too in the business setting. Very important benefit there. Some other tax considerations, I get these questions quite a bit, and they're nice to remember. HSA and MSAs are eligible to pay for long-term care insurance premiums. HRAs are not. So S is yes, that rhymes, right? HSA, MSA, R is no. S is yes, R is no. Flexible spending accounts as well are ineligible, I think. I might need to double check that one. I thought I had that memorized, but now I'm not as certain. So I can check on that one for you, Jen, because we get that question too. I believe the FSA is no, though. And I can shoot an email to Jen to let her know that and distribute that to the field. Another strategy out there sometimes in terms of trying to find ways to pay for premium is gifting. You can gift $15,000 to anyone annually without paying federal gift taxes. That's called the annual gift tax exclusion, and the IRS doesn't want to try and track small amounts that are being paid between family members and friends. To administer that would be too costly. So the IRS gives us $15,000 a year that we can give to anyone. Doesn't have to be a relative, on an annual basis. and don't worry about paying gift taxes. There's also the unlimited exemption for medical care. And you can give an unlimited amount to anyone again, as long as it's paid directly to a provider of medical services. And that would include premiums, health insurance premiums. But for long-term care insurance, it is limited to eligible premiums that qualify for this. So this is capped at the eligible premium. But if I want to pay for my son or my daughter or my parents' long-term care insurance premium, I can do it as a gift, and I won't have to worry about paying any gift taxes as long as I pay the eligible premium. So that's another strategy. If you've got clients out there, older clients that are paying for themselves and they're wealthy and they're trying to figure out ways to lower their estate and gift away assets, they can do this, and it's a really tax-efficient way of doing it. No gift taxes at all if they pay it directly to the insurance company and eligible premiums only. Many states out there also offer tax incentives for long-term care insurance in terms of deducting premium as well. There are too many to go through, obviously, on this phone call. What I always recommend is you go to either your state's Department of Revenue website and search there, or the association, the American Association for Long-Term Care Insurance has a nice detailed listing of all the tax benefits of long-term care insurance that we've been going over today, in addition to a listing of which states provide a tax incentive for long-term care insurance. So that's the AALTCI, I believe it's .org website, and they've got a nice listing of the tax benefits of long-term care insurance and at the state level as well. Here's one final great tax benefit that's available to retired public safety officers, is that they can take out $3,000 a year from their pension, from their retirement plan, and it's tax-free to pay for long-term care insurance. But again, similar to the medical gift tax exemption, it has to be distributed directly to the carrier. Can't go to the retiree and then they write a check to the carrier. Directly from the plan to the carrier, $3,000 out a year, tax-free. So don't have to worry about deductions and eligible premiums. It's $3,000 a year. And usually that can buy you a pretty decent policy depending on your age. So if you've got an ex-police officer or fireman in front of you, maybe also maybe they were working in the ambulance care, things like that, part of the fire department, those individuals are eligible for this benefit as well. So with that, I'm going to see if there are any questions out there. I don't know, Jen, are we going to do questions? There are a lot of great benefits. I know we talked about a lot of information too, so there may be a need to clarify a few things. But if you remember, good, better, best, individual is good, pass-through entities are better, C corporations are best. That's an easy way to try and remember what we went through today.
Yeah, thank you so much, Tom. We can't open it up for questions, but if you do have a question, you can certainly type in a question. If you type in a question, I'll just read it and then hopefully have Tom answer it here. We do have a question, Tom.
Okay.
Can you go over, it says go over the, I think he said means policy benefit again, but I'm not sure what the question is. You might have to retype your question in, Fred. He expanded by saying, okay, so go over the policy benefit again, and then he said service personnel 3,000 deduction. Does that make any sense to you, Tom?
Yeah, at the end I was talking about the benefit that's available to the public safety officers they can get a distribution out of their retirement plan up to $3,000 a year to pay for long-term care insurance premiums. And that distribution is not considered taxable income to them. So they don't have to worry about deducting it. It's a $3,000 distribution from the plan directly to the insurance carrier to pay for the long-term care insurance. So that is a really nice benefit for former public safety officers. Now, what was the first part of it, Jen?
I think that's what it was.
Okay.
Now it makes sense. The police benefit again, so that would be the personnel. Yep.
Jen, I was going to just say I looked up, and the FSA is no. It is not an eligible expense to pay for long-term care insurance out of an FSA. And it looks like I was incorrect on HRAs, that you can do it out of an HRA. So it was health savings account, medical savings account, and an HRA are all yes. FSA is no.
Great.
So I apologize for that error.
No, thank you for redoing that. That's great. But it doesn't look like there's any other questions, and we do have this recorded as well. And then if you do have questions, you can certainly call us here at GoldenCare at 800-842-7799. But once again, I want to thank everyone for joining us. And again, thank you, Tom, for coming back on. This is such great information, and we really appreciate you coming on and talking about all the tax advantages for long-term care. So thank you again.
Absolutely, no problem. Appreciate the opportunity, and I hope if anyone has any questions, they're open to giving me a call as well. Glad to help.
Great. Thank you so much. Everyone have a great day.
Thanks, everyone.